Hey guys, and welcome to another webinar. My name is Hamdad Hamid, and today mainly we are going to take how to trade with technical analysis. But before we get into this, I just want to make a quick check if the audio and the screen are clear enough for you guys so we can start with the session. All right, cool. So before we start, please take a moment to read this risk disclaimer. Trading in the forex market, as much as it's profitable, yet it has a lot of risk, especially if you're trading with high leverage. And this webinar is only for educational purposes. Now, today we are going to cover the meaning of technical analysis and how does it work, the pros and cons of it, the difference between fundamental and technical analysis, and last thing, we're going to show you some of the popular strategies used in technical analysis. But before we started, just want to give you a quick introduction about Amana Capital. Amana Capital is number one brokerage company in Middle East. In addition, it has branches in UK, Cyprus, and Malaysia. It is authorized by FCA in UK, SISIC in Cyprus, DFSA in Dubai, and also authorized by Central Bank of Lebanon. And the main reasons why Amana Capital is different from other brokerage companies, segregated clients account. Here, client funds are completely separated from Amana Capital's fund. Protection on deposit, clients also protected under financial services compensation scheme and also protected under investor compensation fund. Top tier banks, pricing and execution, competitive spreads, and flexible leverage up to 500 to 1. Trading platform has the most popular traded platform, which is MetaTrader for trading products. Besides, you can trade with currencies. You can also trade the spot metals such as gold and silver, and futures such as crude oil and stock indices. Ongoing education through webinars and seminars, also to improve your knowledge and to enhance your trading style. So let's start and see what is technical analysis. As a definition, technical analysis is the framework in which forex traders use in their trading to study the price or to study price movement. So I guess the definition is quite simple to understand. So what it says here, that technical analysis is the method that traders use to study the movement of the price, and only the movement of the price, not the cause of the price. So how does it work? Technically, by reading the history of the price, the trader here could define the current trend, and based on that could estimate where the next move would be. So for me as a technical analyst, I have to go back to history to read the history of the price, and based on that history on the chart, I can determine where the next move would be, or estimate the next motion of the market. Plus, I can also predict or analyze where to place my entry and exit points. And we're going to show you how to do that once we start talking about the strategies at the end of this webinar. Okay, so this is technically the meaning of technical analysis. Technical analysis mainly relies on three basic principles: price action discounts everything, price moves and trends, and history repeats itself. So let me explain each one for you guys. Price action discounts everything. As a technical analyst, I do believe that whatever news is going to affect the market or cause any huge movement of the market, eventually the market will digest the news and then place it for me as price on the chart. And again, based on that price, I can determine where the next motion may be or would be later on. And I can decide my where to place my entries and so on. So in short, I don't really put weight to analyze the news. Okay, I don't study the news in here because simply, again, whatever news is going to affect the market, the market itself will just take the result of this news and then place it for me as a price on the chart. So that's the meaning of price action discounts everything, and we don't have to again analyze the news in this case. Price move or prices move in trends. Of course, price is not a constant move. It moves in trends, uptrend, downtrend, sideways. History repeats itself. I'm going to explain the third principle later on during this session. Just hold this idea. Is technical analysis is the only method to trade with? Of course not. We do have here another method called fundamental analysis. And here you need to know the difference between fundamental and technical analysis. As we said previously, technical analysis mainly focuses on studying the movement of the price, not the cause of the price. And therefore, it helps more for short-term traders, and it helps the most to determine where to place again your entry and exit points. However, fundamental analysis in this particular method, here we study the cause of the movement. So technically, it's the studying of the economic and political reasons behind currency move, and therefore it helps better for people who trade long-term or forecasting long-term exchange rate moves. So in short, technical analysis better for, or it's suit the best for people who would like to trade with short-term periods. However, fundamental analysts mainly uh, analysis mainly is for people who trade with long-term or for long-term purposes in general. What is the best? Because one of the common questions related to this to these methods is that what is the best to trade technical analysis or fundamental analysis? Personally, for me, I don't think that there is something called there is a best to trade with. It depends on you. It depends on what type of trader are you. Again, if you're short term, if you're looking to trade in short term, technical analysis is the best. If you're looking for a longer term, fundamental analysis, it would be better for you. So it depends mainly. There is nothing called the best. But however, I highly recommend to keep an eye on the economic calendar, even if you're a technical analyst and even if you're not a fundamental analyst expert or you don't know how to analyze the news. It is quite important to stay away from the market when there is a huge news that you know that may affect the market. Let's say, for example, you're trading with the euro dollar and there is some certain news coming from the ECP that may affect the euro in this case. You need to stay away from this particular hour, okay, before the news, till the market again digest this news, and then take a shape in the market and then go along with it after the news. All right. Now, because today mainly we're focusing about the technical analysis, so we're going to see the pros and cons of trading with technical analysis. As pros, I think we already mentioned that it's better used for short-term traders, and traders here could predict when and where the best entry and exit points. So this is mainly the I guess top three pros of technical analysis. And this is quite important because when we trade, we don't trade randomly. We don't place entries randomly. Okay, we need to know at which levels we need to place our entries, at which levels we need to exit those entries. So technical analysis, it really helps the best in this case. However, cons of trading technical analysis. Trading with technical analysis again is not ideal, so it can be really dangerous to depend totally on the assumption that today's prices predict future prices. We talked previously about one of the principles called history repeats itself. It's not like 100% applies in the market. Okay, I'm going to demonstrate this concept or this principle later on. But again, it's not like an ideal assumption to trade just because based on that thought. And the second thing, relying on charts completely will not help you to pick up the signals about the changing of trend until the change has actually taken place. What does that mean? This that means that if, say for example, there is major news that you may that it has some major news that have a strong effect on the euro again, and you're trading with the euro dollar in this case. And sometimes you're gonna find out that you would find yourself that you're too late to enter the market. Again, that's why I highly recommend to keep an eye on the economic calendar and stay away from the market that may causes a high volatility on the currency that you're trading. And stay away for like 30 maximum 1 hour again. And that's pretty much it. Okay, so till the market again digested this news and then takes its shape, then you can trade along with it later on. And this is an example of the cause of the volatility in here. Notice in this example represents again the volatility and the volatility of the market during the BOC. BOC, it's a Bank of Canada, and technically the news is they kept rates on hold, hinted to of possible rate cut later on, despite the analyzing of the news here. But what I just needed to understand on the dollar CAD on the 1 hour chart in here, after this, in case you have missed the news, it would be too late again. It would be too late to enter the market as we explained previously. Besides that, if you were selling before this, so for example, you were selling at this point and you put your stop loss at this level, it may hit your stop loss before hitting your target profit. So that's why again I highly recommend to stay away before and during the news till the market, till the market takes its shape, till you understand what the news caused in the market by candlestick as price, and then you can follow the trend later on. Next, we'll be talking about types of charts. And here we do have three types of charts. We do a line chart, bar chart, candlesticks chart. Let's start with line charts. Line chart is a line on the chart, as it's shown here. Technically, it's grown by connecting the close price of each session. For example, if I'm trading with the 1 hour chart, the line chart would represent the close price. The line would present on the 1 hour chart. It's a close price of each 1 hour or of each session. If I'm trading with the daily chart, again the line would represent each close price of each day and so on. However, on the line chart, it's really hard to trade with because it doesn't quite show me where the upper and lower limit that the market has approached during the session. And for me, this is a huge disadvantage, to be honest. I can't trade with the line chart, but again, it's one type. Maybe some of the analysts use it in their trading for particular reasons. But the main reason why I don't, because again, it doesn't quite show me where the upper and lower limit of each session in this case. Next, the bar chart. It looks like this, and as you can see here, the bars in general will give you better look how to read the price on the chart. It's quite clear where is my close price, my open price. The high and the low here, the high and the low represents the upper and lower limit that the market has approached during the session. So again, it will give you a better look more than the line chart. If they close above the open, then we said that the market has rallied during this session, and this is a bullish bar. If they close below the open, this is a bearish bar, or in other words, that the market has declined during this session. Again, the high and the lows represents the upper and lower limits that the market has approached during the session. Last, the candlesticks chart, which is the most popular chart among them all. I personally use candlesticks chart, and this is how it looks like. And as you can see here, it even gives you a better look how to read the price. Notice here it's quite similar to, by the way, it's quite similar to the bar chart. However, the close and the open are connected together, creating something called the real body of the candlestick. When they close above the open, this is bullish candle. When they close below the open, this is a bearish candle. And the wicks, notice this line, the upside and the downside, called the wicks or shadows. Again, those represent the upper and lower limits that the market has approached during the session. Next, we'll talk about time frames, and this is quite important. And one of the common questions related to time frames is that what is the best time frame to trade with? Again, personally for me, I don't think there's something called the best. It depends on you, it depends on the strategy you're following, it depends on your time maybe. For example, if you're a scalper, you do have from 1 minute, 5 minutes to trade with maximum. For me, I think 15. I take 15 minutes also for scalping as well. And for people who don't know what the meaning of scalp or scalping those mainly those people who trade within like an hour maximum too, but you have to stay in front of your laptop and make multiple trades in a really short time. Okay, so those are scalpers mainly. So for scalpers, from 1 minute maximum 15 minutes time frame you can trade with. If you're moderate, if you're intraday trader, you do have from 30 minutes up to 4 hours. However, if you're a long-term trader, then you do have from the daily up to monthly chart you can trade with. So again, there's nothing called the best. It depends on you and your time, and again, the strategy you're following and how to apply it to your chart. Now, moving forward, and this is the most important part in this webinar: support, resistance, and trend line. First, let's talk about support. Support, as a definition, is price level where demands are bigger than suppliers, or in other words, where buyers are bigger than sellers in this case. If I ask you, when the buyers bigger than sellers, what's going to happen to the price? By logic, they're going to push the price to the upside. Logic. So it says here, when price is moving down, so you need to remember, for each support level, the previous movement will be a down movement in here. The support line or the support level is the price level that can stop the downward move as well as rebound from it. So again, what it says here, that the previous move is a downtrend till it reached to an area called the support area. And this area here, we're going to find the buyers located and bigger than suppliers. And therefore, here we estimate that the buyers may push the price to the upside and rebound from this level and, reverse. The trend will reverse from downtrend to uptrend. Okay, so this is support level definition, and any previous support is considered any previous low considered as support. And vice versa for resistance. Resistance is the price level where suppliers here are bigger than demands, or in other words, where sellers are bigger than buyers. And again, when sellers bigger than buyers in this case, they're gonna push the price to the downside. And remember, for any resistance area, the previous move of the resistance area would be an up movement, and therefore the resistance here is the price level that can stop the upward move, and price could rebound from it as well. So again, it's an upward move till it reaches to some level called resistance, where sellers here are located and they're way more than buyers. Then at this area, we estimate that the price may push or may decline at this particular level and reverse from up movement to down movement. And any previous high is considered as a resistance. Now let's take this example just to understand again the concept of support and resistance. This, as you can see here, it's a sideways movement on the market. And first of all, I don't think I mentioned it, but first of all, you need to know how first to draw a support and resistance line. It's quite simple. To draw a support line or support level, you need two points or two lows to draw a line, and the third to confirm the level. So in here, to draw a support, I'm going to locate two lines, two points to draw a line, and third to confirm the level. Okay, the same thing applies to resistance. However, drawing resistance is just connecting two highs and third to confirm the level. Now notice here, The price was moving sideways and it reached to the support area. And we said previously here the buyers are more than the sellers in this case. So they're going to push the price to the upside as it's shown in this example. They push it technically right to the resistance where the sellers here are located. And they are more than the buyers in this case. And again, we said when the sellers are more than the buyers in this case, then the sellers are going to push the price to the downside, and they did till it reached again back to the support area. Buyers here located higher than or bigger than the sellers push the price upward and so on. If I'm going to ask you what kind of information I get from this, like drawing support and resistance, I said previously that we don't place entries randomly. So for me, I need levels to know where to place my buy position and where to place my sell position. So I think quite obvious where to place my buy and sell position at this case. As a general rule, whenever I think of buying in the market, I have to place my buy position on a support area. Why support area? Because again, buyers would be located in this area and would be more than sellers, and they're gonna push the price to the upside. And vice versa for a selling position, where I'm gonna place my sell positions, I'm gonna place it at resistance area. Why is that? Because sellers in this case are located at resistance area, and they are more higher or bigger than the buyers in this case. So I want to sell with them. Okay, so think about it this way. There's two teams in here in the market, with buyers and sellers, and in case I want to place a position, I need to place some position with the winner team. Okay, so the support area, most probably the buyers would be the winner, so I'm gonna go with them. On the resistance area, the sellers here most probably will be the winners, and I'm going to sell with them. Okay, do not do the quite opposite, because one of the common mistakes here is that people just buy on resistance area and sell on support area. And I'm just going to show you, I'm just going to explain the rule of alternation later on, but you need to know the concept of support and resistance area. Again, as a general rule, think of buying on a support area and think of selling at the resistance area. Okay, one more thing I need to explain here. Remember the concept that I talked about, history repeats itself? Notice in this example that when buyers push the price to the upside till the resistance and then went all the way back to the same area. Now, in this case, or in this particular area, for me as an analyst, we'll again go back to history and we'll see what happened to the market when the market has approached to the same level. So here I saw that the market technically pushed the market rallied at this point. So for me, as to analyze the movement or anticipate or predict the next movement here, I would say that maybe at this particular level, that buyers will take an action and push price to the upside, just the same as what happened previously. This is the meaning of history repeats itself. Okay, but again, it's not like just go buy because the previous movement was a buy. You need a confirmation for to go along with it, but you just need to understand the concept of, again, history repeats itself, and this is pretty much it. The same thing goes in here. In the resistance area, this particular level, sellers push the price to the downside. And when the price went back to the same exact level, you need to go back to history and see what happened to the market in here at the same particular level. So it was a selling, or if it was like a decline move, then here I estimate that the sellers may push the price lower, just the same motion that happened previously. However, again, I need a confirmation to go along with that. Now, if you after we talked and we now know the difference between the support and resistance area, you would understand the rule of alternation easily. I just want you to memorize one sentence: that any broken resistance becomes support, and any broken support become resistance. Again, any broken support become resistance, and any broken resistance becomes support. And just to understand the concept of it, notice in this example that here the market was moving sideways, okay, between support and resistance. And as we said earlier, that price moves in trends. So it's not a constant move. So substantially, it will break either to the upside or to the downside. In this example, the break happened to the upside. And that indicates that the buyers are aggressively higher than the sellers at this point to push the price higher and make higher highs, higher lows. In another means, that's an upward or an uptrend move, making higher highs, higher lows. Now, as you can see here, after the higher high has been occurred, notice when the market fell to make a new low, it tasted the previous resistance at this point and rebound from it. With that being said, we say that the previous resistance is now our current support, and we can make buy entries on this level as the market is moving higher. Let me just repeat what happened. Higher high, and we need a higher low to confirm an uptrend in this case. So notice here when the market fell back or correct, it didn't went all the way back to the previous support. It tasted the previous resistance level and rebound from it. And since the market rebound from this area, that means that the buyers are located in this particular area. So this is a support area. And notice the support area, my current support area, is the same as the previous resistance. That's why I just said that you need to memorize the sentence that any broken resistance becomes support. Is it 100% an ideal rule? I wouldn't say like 100%, but once you start trading, you're gonna find out, yeah, maybe like in 80%, the 80% of the times that the market actually applies with this rule, that any broken resistance becomes support and so on. Okay, so this is pretty much it. And vice versa, by the way, for the any broken support becomes resistance. That here, if the market breaks the support area, then once it will correct, it will most probably, I'm not gonna say that it will, we'll say that most probably will correct to the previous support. Now, if it rebounded from it, we said that now the previous support is our current resistance and so on. Okay. So this is the rule of alternation, and it helps the most again to locate my entry and exit points. I personally, for me, I use the rule of alternation mainly to place my target profits the most. But again, it's quite helpful to place also where is my entry positions as well. So it's quite important to know how to locate those levels. Notice in this example, this is an uptrend. Broken resistance becomes support, broken resistance becomes support, broken resistance becomes support, and so on. Okay, and just again, another rule I'm going to add in here is that when you see an uptrend like this, only focus on buying position. Do not fight the market. Do not trade against the market. Again, in general, we're not gonna take or trade every candlestick on the market. Okay, we are taking only pieces in the market, and those pieces has to be confirmed. So do not get confused. Just focus on one position in this case. When the market is moving up, only focus on buying position. When the market is moving down, only focus on sell position. Again, remember that you need to go with the winner team. Either go buy with buyers or go sell with sellers when the market is moving down. Next, we do have trend lines, and trend lines it's quite similar. It's the same support and resistance area, but with the slope. So it just like a different name, but it is the same support and resistance area we're talking about here. And here we do have three types of trend lines. We do have uptrend, downtrend, and sideways. Again, for uptrend line, it will create higher highs, higher lows as a market. The downtrend would create lower lows, lower highs. However, on sideways will create would create horizontal highs, horizontal lows, or equal highs, equal lows. Okay. Now, again, one of the common questions related to trend lines is that, okay, I can see that the market is moving to the upside. Why do I have to draw a trend line that tells me that the market is moving to the upside? Personally, for me, I think the most important 2 points in here is the length of the trend lines and number of times that the trend has been touched or approached. And let me give you a simple example here, just to understand the concept of these 2 points. If you do have a friend that or you met someone, I'm not gonna say this friend, you met someone for like previous week or a week ago, and there is another friend you do have here that you have known for like 10 years, and let's say that you don't have a secret and you need to tell someone. Who would you trust the most? The person you have met a week ago or the person that you have known for 10 years? Generally, as a logic, we trust the person that we have known for like 10 years. Same thing here. The longer the length of the trend line, the more it's trusted, and the more if the break happened with this long trend line, the signal would be really, really significant, really, really important in the market. Okay. Besides the number of timing that has been touched, of course, if there is a trend line, a long trend line that I have seen a rebound from it, say for example 5-6 times, is quite more important than if a trend line has been rebounded from it 2 times. Okay, and besides that, denoting the direction of the trend, if it's an uptrend, downtrend, and marketing timing, because again, it applies the same rule as support and resistance area. And I'm just going to show it to you. Just going to show it to you how. Notice in this example, this is an uptrend, right? How to draw a trend line or an uptrend line? Remember, you need to connect the lows together. One of the common mistakes in here, I've seen a lot of beginners, when they see an uptrend, they draw an uptrend line connecting the highs together, and this is quite wrong. And let me explain why. Again, when it's an uptrend, we said that buyers are more than sellers. Okay, so we need to buy with them because they push the price higher, right? So I need to buy with the buyers. All right, so where did I say that buyers are located? We said that buyers are located at support area. That's perfect. So how to draw a support area or support level? Drawing a support line or support level is connecting lows together. And notice here, what I just did is just connecting the lows together, creating an uptrend line. So why I'm creating this, connecting the lows? Because I'm technically I'm drawing a support level to see where to place my buy position at this point. So whenever the market touch or approach to near to the uptrend line or the support area that I have just drawn in here, I need to think of buying. Okay, so in this case, buyers would be located in this particular level. So always remember, on an uptrend, you draw a trend line or you draw your uptrend line connecting the lows together, and vice versa. For drawing a downtrend line, you need to connect the highs all together. Why is that? Because again, in a downtrend, think that sellers are more than buyers. In this case, they're gonna push the price downward, and for you to focus on a position, you need to focus on selling position at this point. And where to sell, or where's the level that I can sell at, is the resistance area. How to draw a resistance area, connect the highs together. And once the market approached this particular level here, you need to think of selling the market. Okay. Now, moving forward, we are going to talk about the most popular strategies used in technical analysis. And by the way, there are a lot, but for today we are going to focus on only three: Elliott waves, price action, divergence of CCI indicator. And let's start with the Elliott waves. And by the way, Elliott waves strategy is one of the most complicated strategy used in technical analysis. It's really quite complex strategy, and mainly people who trade with Elliott waves, they trade it for long term purposes. Okay, but for today I'm just going to show you the concept of Elliott wave. So the theory says that the market moves in a repetitive rhythm of waves, that one complete cycle has 8 waves: 5 up, 3 down if it's an uptrend, 5 down, 3 up if it's a downtrend. Notice here, this is a one complete cycle. This is wave number 1, 2, 3, 4, 5, and then followed by A, B, C, the 3 waves down in here. Now, wave number 1 and 3 and 5 called impulsive waves. And impulsive waves mean that when the market pushing the price to the upside or making rallies in this case. And waves number 2 and 4 are corrective waves of waves number 1 and 3 respectively. Okay. After the 5 waves completed, it will be followed by the corrective waves of ABC that corrects the previous 5 waves. This is pretty much Elliott waves. And let me just show it to you in here. Notice this market. This is wave number 1, 2, 3, 4, 5, and followed by A, B, C, and then 1, 2, 3, 4, 5, and then will be followed by A, B, C, and so on. So this is the how it looks like. Again, it's one of the most complex strategies used in technical analysis. And how to trade it technically, you have first to identify the trend and start counting the waves. Say, for example, like if you count wave number 1, once the wave number 1 completed, then you need to prepare to sell the corrective wave of number 2, and then once when wave number 2 completed, then you need to prepare for another buy. In this case, to prepare for a buy position to trade wave number 3. So in general, like buy the impulsive waves and sell correction waves. This is pretty much it. Now, moving forward, the CCI. The CCI stands for Commodity Channel Index, and it is an indicator placed below the chart as it's shown in this example. And what does it do? It tells when the market has approached to the overbought and oversold regions. So, and for people who don't know the terms of overbought and oversold, overbought, that means that buyers here are pretty much exhausted. They really really tired. That they can't push the price any higher, and that indicates that the price may reverse at this point and may see a decline. And vice versa for oversold. In this case, sellers here cannot push the price any lower, and that indicates that we may see a reverse and we may see rallies at this point. The CCI fluctuates between negative and positive 100. The reading below negative 100 considered to be as an oversold, and the reading above the positive 100 considered to be as an overbought signs. Now, how to trade with CCI? We do have technically 2 ways to trade with CCI. Trade with the fluctuation above and below the positive and negative 100, and to trade with the divergence. First, let's take how to trade with the fluctuation. And again, here I don't want you to get confused trading with this particular indicator, but you need to know that using indicators in general will give you false signals. That's why we need to to reduce as much as possible of those false signals. Okay, so what we need to do is to focus on the main trend. If the main trend is moving up, or the main trend is an uptrend, only take a buy signals that CCI will give you. And if the main market here is down, then only take sell signals that the CCI will give you. And in other words, as it says here, if the main trend is up, only take oversold signals. Why it's oversold? Because again, oversold means that the sellers are pretty much exhausted. Okay, and when the CCI is at oversold region, that indicates that the market may reverse at this point and we may see rallies. Okay, that's why I need to take oversold signals from CCI when the market is moving up, and vice versa when the market is moving down. Then here I'm going to take the overbought signals from the CCI. Okay, let me give you here an example. Notice in this example, this is the downtrend. This is a downtrend move. The very first thing I did is that I draw my basic trend line, and it's quite important. By the way, we do not rely on indicators by themselves. You have to combine your basic analysis with the indicators to get the full confirmation to go along with your position. So notice in this example, the market was moving down, and notice here I just took the signals that CCI give me that it's above the positive 100 because this is the overbought area, along with the market is rebounding from the trend line. Notice in this example, again, rebound from trend line plus the CCI is above the positive 100, then this is a sell entry position. And another one, rebound from the trend line plus the CCI is at or above the above positive 100 here, and this is a sell entry position. Okay, so again, do not rely only on the CCI. You have to combine your basic analysis in this case with the indicator to get the full confirmation. And notice in this example, I totally ignored all buy positions in here. Notice that the market here is giving me a buy signal. Here, this is a massive buy signal, and this is a massive buy signal, but I totally ignored it because, again, the main trend in here is, or the current trend in this case is down. Another example, notice this is a big uptrend. However, I'm gonna only trade the buy positions. Notice when the CCI is rebounding from the trend line, place your buy position. We do have here another one, and here we do have again another one, and so on. Okay, so again, just focus on the main trend and get along with the CCI and focus on only one position. Now, next we are going to talk about the divergence of CCI. The second way to trade with the CCI is divergence. And for people who don't understand the meaning of divergence, divergence means that when the market is moving to the upside, or it's not to the upside, on a certain direction, CCI would give you quite the opposite. Notice in this example that the market was moving to the upside, creating higher highs, higher lows. This is an uptrend. I guess it's quite obvious. If let me just draw a line in here. Sorry. This is an uptrend. Okay, higher highs, higher lows. However, the CCI is giving me quite the opposite. In this case, that indicates that the price may fall afterward. Okay, so let me just erase this. So yeah, let me repeat that. The market was moving to the upside, and then, however, the CCI gave me quite the opposite. One of the things that CCI should do, by the way, is to confirm the direction of the trend. So if it's an uptrend, the CCI should give me higher highs, higher lows. If it's downtrend, the CCI again should give me lower lows, lower highs. However, at some point, this divergence happens, and when that happens, that indicates that the market may reverse at this point. And this example, again, the market was moving to the upside, higher highs, higher lows. However, the CCI is giving you quite the opposite. This indicates that the market may fall after this divergence. However, if I'm going to trade this, I'm not gonna trade just because I saw this divergence. What I'm gonna do, draw your trend line, uptrend line. And for me as an analyst, I would say, okay, I'm going to place a sell position only after a close price below the uptrend line. A close price below the trend line plus the divergence, then I'm more confident to go and sell the market afterward. And notice here the market technically fell apart. Okay, so do not just jump in and sell in this case just because you saw divergence. Again, just to remind you, CCI or any other indicators may give you a false signal. So I'm not going to just place entries only relying on this kind of reading. Especially I'm talking about the CCI. You have to combine your basic analysis, draw your support to resistance and trend lines first, and then if a market breaks or a rebound from your basic lines, along with the signals that this indicator will give you, then yeah, go ahead. Okay, but however, again, do not rely on CCI, since we're talking about particularly about CCI. Do not rely on it by itself. Okay. Another example here. This is a downward movement. This is lower lows, lower highs. However, CCI clearly shows a different direction in this case. Again, that indicates that the price may go higher or reverse at this point. However, I'm not gonna buy unless I see a break below, break above the downtrend line. Let me just draw it here real quick. For example, this is my downtrend line, and once I see a break above this trend line along with the divergence that CCI gave me, then I'm more confident to go and buy at this point. Now, last but not least, the reversal candlesticks, and here mainly we're referring trading with price action and using reversal candlesticks to trade the price action. For now, I'm just going to give you the top two reversal candlesticks to trade with, which are the hammer and shooting star. And let's start with the hammer. Hammer, of course, is one of the most significant reversal candlesticks. It usually occurs on bottom of the market, and meaning the bottom of the market here, I'm referring to a support area in this case. See, I don't want you to I don't want you just to memorize how it looks like. It's really, really important to understand what happened during this session, what happened in this hammer itself. By the way, it looks like a hammer. That's why it's named as a hammer. But what happened in here, as we said, that it usually occurs on the bottom of the market or in the support area. That means that the previous movement was a downward movement. Okay, so what happened in here is that the market opened at this level, traded below, as the market was already moving down previously, so it's traded below. It's all good. And then, however, for some reason, we don't know what happened, the market, the buyers at this point, push the price to the upside and close near to the open price, leaving a long lower wick or a long lower shadow in this case. Okay, I do not care about the color of the body. I care about the longer the length of the lower wick. The longer the wick is, the more reading of the more sign that tells me that buyers may continue with their movement to push the price higher on the next session. Okay, you need to understand that hammers and or any candle or any reversal candlestick, but for now, because I'm talking about the hammer in here, a hammer is considered as reversal candlestick, but it's not like enough reason to go and buy after the hammer. We need a confirmation to go and buy after the hammer. I'm just going to show you how to buy with this particular candlestick, but again, it just will give you a signal. That's it. It's not a confirmed signal though. Now let's see how to trade with the hammer. The very first thing you need to do is to place your support or resistance area. I think that's the APC. That's for any strategy you're using, you have to place your support and resistance and trend lines. So for me, I placed my support and resistance areas, and then I waited for the market to give me a buy signal. And I needed the buy signal to occur at the support area. Notice here, this is a resistance support, and this is a support area. This is the hammer. I don't know if you can see it well, but this is a hammer. So how can I trade the hammer? It's quite simple. I'm going to place a pending order. Precisely, I'm going to place a buy stop order right above the highest high that the hammer has approached during the session. And what do I need? I need a close price at above this particular level. Okay, again, a close price, not just that the price touch my pending order and then hold in there and then decline. If that happens, you need to get out from the market. I need a close price. I think it's quite clear here that this candle has closed above the hammer. So in this case, my buy position is activated by now. My stop loss would be lower than the support area. Personally, for me, I prefer to be lower than the a few pips below the lowest low that the hammer has approached. And using the rule of alternation, I'm going to place my target or TP, take a profit. Okay, and notice that the market has technically hit my or both my targets in here and even push the price and even higher. Another example, this is the dollar franc on the daily chart. Again, place your support or resistance area and wait for the market to give you a buy signal. Notice this is a really significant hammer on the daily chart. Notice how long this lower wick is. Okay, so this is again a massive buy signal. However, it's not confirmed yet. How I'm gonna trade it? I'm going to place a buy stop right above the highest high that the hammer has approached. Again, I'm gonna place my stop loss below the support area. Using the rule of alternation, again, I'm going to place my targets as it's shown in here, and notice that this right in the next day the candle closed above the hammer, so for me I'm more confident to go and buy along with it. Technically the pending order has been activated in this case already. Okay, so this is pretty much it. Notice again the market has hit my 3 targets in this case. Now we talked about the hammer. It's quite similar to talk about the shooting star. The shooting star is it looks like a hammer, but it's kind of reversed. The hammer we said placed on support area, or usually occurred on support area. However, shooting star it occurred on the top of the market or in its resistance area, and this is a sell signal. So how to trade with it? Let's take an example. Again, the same concept. The very first thing, once you open the chart, draw your support or resistance area and wait for the market to give you either buy or sell signal. In this example, notice this is a really good shooting star. This again considered as a sell signal. It's not enough reason to go and sell right after this. What you need is just to place a pending order below the lowest low that the shooting star has approached. Place your stop loss above the resistance. For me, again, I like to place it a little bit above the upper wick of the shooting star, and then using the rule of alternation, placing your TP. And notice that the market already hit. Another example here. This is support. This is a resistance, support area. So for me, I'm looking to place an entry at this particular level. And notice this is my shooting star. Once that happen, again, place pending order right below the lowest low that the shooting star has approached, and placing your stop loss above the resistance area using the rule of alternation. It's quite obvious that it hit my TP in this case. Okay, so this is a price how to use or how to buy and sell using the top two. For me, it's like top two reversal candlesticks, and it's quite efficient. I really want you to start trading with price action. Try this particular method, and just tell me your feedback about it. So this is pretty much for me for today. Thanks for watching and hope you enjoyed today's webinar. And don't forget, tomorrow we'll be talking about top technical indicators used by FX traders. It will be a really fun webinar to attend, to be honest. And it will be tomorrow at the same time, 1 p.m. London time, 4 p.m. Dubai time. And if there is any further questions, you can follow me on Twitter, @Hamid, or send me a message, an email through my personal email, and once I see your message or email, we'll reply you as soon as possible. Thanks for watching and have a good day. Until I see you next time, have a safe trade. Bye bye.